class now. So, okay. So, welcome to class today. Class has started. What to do this week is Saturday, April 19th. We have the Chapter 10 homework. Chapter 10 homework, just a heads up. We did the homework problems on Thursday of last week, and they were also embedded in the Chapter 10 videos. The attendance quiz 22 is largely going to come from those questions we do today. So the handout with the 22 questions, that's most of what the attendance quiz is. It might relate a little bit back to last Thursday. I don't think so. Could have a little bit from this coming Thursday too. Sunday video quiz 23, we're rapidly approaching the end. There is only one chapter past chapters 11 and 12. Chapters 11 and 12 are fairly small. That's why they're combined into one set of videos. Okay, so today we're doing chapter 10. And as I said last week, we're doing questions today. So we have 22 questions. They're on a wide range of topics in Chapter 10. Chapter 10, the major overall topic about Chapter 10 is stockholders' equity. When we look at the learning objectives for Chapter 10, there were just 4 learning objectives, including the features of a corporation, the issuance of stock, treasury stock. Remember that treasury stock is our own stock we buy back, and then retained earnings, stock dividends, and stock splits and regular dividends. So that's just, it's a fairly small chapter, but I think we'll have some questions today that aren't immediately obvious. So again, I want to get the URL for the handout in the recording here. It's in the chat window, but if you just joined, we probably need to put it in again. The handout of all the questions for today is http://tiny.cc/April15class. So all the questions for today are in that PDF document. You can feel free to download it, and then we will go through the questions. So what we're going to be doing today, our whole day, is we're going to hit a question, we'll wait a minute or two and gather answers, and then we'll go through the answers. So the first question, and again, if you have your device, you're going to see these questions pushed out to you. We had the first question was sitting there so you could answer it. I believe you can change your answer if you wish. But the first question is a true or false question. A debit balance in retained earnings indicates that a company's lifetime earnings exceeded its lifetime losses and dividends issued. True or false? Good. Okay, debit balance and retained earnings. First of all, retained earnings has a normal credit balance. So a debit balance is that something's wrong here. So did you push out the answer? Okay. This is false. Retained earnings has a normal credit balance. A debit balance means that a company's dividends issued and losses have exceeded its lifetime earnings. So you wouldn't want to see a debit balance and retained earnings normally, because that means you've had more losses in dividends than you've had earnings. Okay. Okay, next question. So we're moving to question 2. Haley, when I say question 2, you can push it out. Okay. Okay, the total stockholders' equity remains the same before and after a stock split. True or false? Okay. Total stockholders' equity remains the same before and after a stock split. That is absolutely right. A stock split, all you're doing is doubling the number of shares outstanding, and each share is now worth half of what it was worth before. So nothing changes in total. Okay, question 3. Question 3 deals with declaring a cash dividend. So when we see this question, question 3 on your handout, the effect of the declaration of a cash dividend. When we see this question, immediately you should be thinking about that journal entry. So if you think about what the journal entry is when you declare a cash dividend when you answer this, then you should be able to pick the answer out. Okay, for question 3 then, the effect of the declaration of a cash dividend. When we declare a cash dividend, we're going to debit retained earnings and credit dividends payable. So we debit retained earnings, credit dividends payable. So what's happening there is we are decreasing stockholders' equity and we are increasing liabilities. So down at the bottom of the screen there, I've written that journal entry. Again, that would be a journal entry that I would want to put on my sheet for the exam. What happens when I declare a cash dividend? So when I declare a cash dividend, my journal entry is going to debit retained earnings, which reduces stockholders' equity, and going to credit dividends payable, which increases liabilities. So that's why the answer is A there. Moving on then to question 4. Question 4, the date when a cash dividend becomes a legal obligation is on what date? So the date when a cash dividend becomes a legal obligation is which date? Okay, the date when a cash dividend becomes a legal obligation is going to be the declaration date. Until we declare that dividend, it is not a liability. So when we declare the dividend, it does not Healy? Healy? What? Okay, is there one now? Okay, let me go check with her real quick. Okay, question 5. If a corporation declares $100,000 cash dividend, the account is to be debited on the date of declaration is what? So you're good now. Okay, that should be fixed now. Okay, if a corporation declares a $100,000 cash dividend, the account to be debited on the date of declaration, we're going to be debiting retained earnings. Okay, so the answer is going to be C. Retained earnings, and it will show up. There we go. Okay, and again, declaring a dividend, we're going to debit retained earnings, credit dividends payable. Okay, now on to question 6. When preferred stock is cumulative, so this is looking at the meaning of the word cumulative, preferred dividends not paid in a year are what? A, distributions of earnings, B, called dividends in arrears, C, a liability, D, never paid to preferred stockholders. It's your question on the screen right now, isn't it? That matches? Okay, okay, thank you. This is a vocabulary one, so what we're looking for here, when we say preferred stock, it's cumulative. If we don't pay the dividends in a given year, they're called dividends in arrears. Dividends in arrears are not a liability, but dividends in arrears on preferred stock have to be paid before we can pay any common shareholders. So dividends in arrears relate to preferred stock cumulative dividends not paid in a given year. Now, the next question follows up on that dividends in arrears. Okay, before a company can pay dividends to the common stockholders, the owners of cumulative preferred stock must receive what? And this question 7 relates to dividends in arrears. Okay, so before a company can pay dividends to common stockholders, the owners of cumulative preferred stock means all the preferred stock dividends in arrears have to be paid before we can pay any common stockholders. We have to pay everything in arrears, so everything from prior years, plus the current year's dividends. So we have to do both of those. So the answer will be C. Next, moving on to question 8. Question 8, a share of 5% preferred stock. So that's how preferred stock is talked about with a percentage. A 5% preferred stock has a par value of $50 and market value of $75. The owners of the preferred stock will receive a dividend of what? How much per share? Okay, what we're going to see here is the answer is A. What we do, pretty straightforward. It's always a percentage of par value. So it's going to be that 5% times the $50 to get a dividend share of $2.50 per share on that preferred stock. So it's always the percentage times the par value. Okay, next question 9. When 100 shares of $1 par value common stock are issued at $25 a share. So here we're selling them for $25 a share. Their par value is $1 a share. Paid in capital in excess of par value will do what? Okay, what we're going to see here is the paid in capital in excess of par is exactly what it sounds like. We have $1 par value. We were paid $25. So we will get the extra, the $24 a share times 100 shares goes into paid in capital in excess of par. So that actually is what the account title says. This is this account that we put everything above par value into. Par value always gets put into common stock. Common stock only holds the par value. So if you know the par value and you know the balance of common stock, you can figure out how many shares of stock you have. Okay, so that will increase by 2,400. Question 10 then. Question 10. If stock is issued for an asset other than cash, the asset should be recorded on the books of the corporation at what? So an example of this is I start a business, I start a corporation, and instead of giving the corporation cash, I donate a building to it. And a lot of times that happens with small businesses. They'll say, well, I've got this building, I'm going to incorporate, so I'll donate the building to the corporation. So how should we record that asset? In this case, how should the building be recorded? At the fair market value, at its cost, at the par value of stock, or at zero? And it is the fair market value. So when you issue something, if you're going to donate something to a business when you start it, it gets recorded at its fair market value. This next question, is actually the next two questions relate to the same, I use the same data set. But question 11 says Wolverine Corporation issued 5,000 shares of its $5 par value common stock in payment for attorney services of $40,000 and gives us the market price for Wolverine stock, and then asks us what do we debit, and what do we credit? So we kind of think about the journal entry and the amount. And this one, some of these are pretty challenging, and I designed them to be so. So this one I'm just going to go ahead and answer. What we've got on here is we're going to value when we get services in exchange for stock. Again, it's the fair market value of the services we got. So we're going to debit legal expense for $40,000. So we got legal services of $40,000, but we gave them stock instead. So we're going to value that at legal expense for $40,000. So that's question 11. Now we take that, and question 12, very similar. It's same data set, but now it's asking us about kind of the other side of this. We have a debit to legal expense. What else is going on here? And I'm going to skip to the answer on question 12. So we're going to, so if you want to enter it, that's fine. But what I've got down at the bottom is the actual journal entry. So if you get legal services in exchange for stock, or whatever you get, you debit what you get, legal expense here $40,000. Common stock is always credited for its par value. So we have $5 par value times 5,000 shares. We have a credit to additional paid in capital of the 40,000 minus 25, because my debits have to equal my credits. Actually, George, this journal entry that we have for question 12 will answer question 11 for you as well. So this journal entry relates to question 11 as well. Okay. Okay, now we're going to go through a whole series of questions that aren't multiple choice. So if you're online, this is where Brian said you feel free to enter it in the chat window. So these ones coming up. If you're dealing with, if you have the device, you enter numbers. Okay. So Liberty Corporation has the following information as of the end of the current year. So you have common stock that has $10 par value each, authorized 20,000 shares, and the total balance in common stock then 70,000. I want to stop here and talk about what the word authorized means. When we have shares that are authorized, that simply means this is the most shares this company can issue according to its articles of incorporation. So it could never issue more than 20,000 shares. So that's just informational for us. So it's telling us common stock has a balance of 70,000. Remember that common stock only holds par value. Then we have treasury stock of 2,000 shares that has a balance of 30,000. Based on the information, how many shares of common stock are outstanding? on this one, the answer is actually 5,000. So let's talk about why it's 5,000. Our closest answer was 7, and that's part of the answer certainly. So let's talk about, first of all, common stock. Yes, we have 7,000 shares that we issued. So 70,000 is our total balance divided by our $10 par value each gives us 7,000 shares. That's issued, and that's key. We issued 7,000 shares. But now we're talking about shares that are outstanding, meaning out in shareholders' hands. So we have to subtract the 2,000 that we bought back. Remember that treasury stock is our own stock that we bought back. It is not considered outstanding. So our answer here is 5,000 shares. So the 7,000 was really close. That was issued, but we have to subtract the 2,000 shares that we've bought back. And remember, authorized is just how many that we're authorized to issue, but doesn't mean that we've issued those. So we actually have to calculate it in this case. Common stock, that 70,000 is the par value of the stock. So if we know it's par value, we can take the 70,000, divide by $10 par value. That's where we get the 7,000 issued, less the 2,000 shares of treasury stock. Okay, now question 14, same set of facts, just a different question. Based on the information, how many shares of common stock have been issued? And this one we should get. Okay, and yes, it is 7,000. Yes. So we have 7,000 issued. Again, that's the 70,000 balance in common stock divided by the $10 par value because common stock only holds the par value. So 7,000 have been issued. So we have three numbers here. We have authorized, which is 20,000, which is how many they're allowed to issue. We have 7,000 that they issued, and we have 5,000 that they actually have outstanding because we have to subtract the treasury stock to get to the outstanding. Okay, another one. Question 15. Robertson Corporation incorporated on January 2nd, 2012. During 2012, Robertson had the following three transactions. This one is a lot easier than it looks. When you first look at it, it's got a lot of numbers in it. It's asking for the total amount of stockholders' equity. So you have to do a little bit of multiplication and some addition there. So go ahead and try this one. It's not very hard when you get down into it. Okay, I have to see the back of your phone. Oh, Haley, hold it up. How many, Haley? Okay, total amount of stockholders' equity. What you have to do is you have to look at these three sums. All three are important. So I see three of the right answers in the chat window, 4 now. Okay, so we issued 30,000 shares of common stock at 25, so we multiply 30,000 times 25. We purchased 2,000 shares of treasury stock at 28. We multiply that. We have to subtract that because that's treasury stock. It reduces. And then we have the net income of 400,000 that increases. So I've put the calculation down below. So we have basically common stock of 750,000. We subtract the 56,000 of treasury stock that we purchased, and we add the income of 400,000. So our answer is indeed 1,094,000. And I was really impressed. Is that Kaylee? I can't read the name from here. Is it Kaylee, the first name? How fast you got the answer online. That was really good. So, yeah. That's good though. Everyone had the questions. Okay, so the answer is 1,094,000. So big thing here is to remember that treasury stock reduces stockholders' equity. You cannot own yourself. Okay, now if you're in, well, either if you're online, you can do it in the chat window. If you're in here, type, the answer for this is an abbreviation, so use the acronym. What is the title of the chairperson of the board of directors? So I'm looking for an abbreviation here, not the whole spelled out word. So you can do it online. You can how many answers do you have? Okay, the answer in this case is indeed CEO, Chief Executive Officer. Okay, chairperson of the board of directors is CEO. So it is Chief Executive Officer. I was looking for the acronym of CEO, so you wouldn't have to type Chief Executive Officer. So CEO is the chairperson of the board of directors. Okay, next question also requires you to type in a word. So what is the title of the chairperson? Oh, no, that was the one we just did. If a corporation has only one class of stock, it is understood to be blank stock. So question 17, if a corporation only has one class of stock, it is understood to be blank stock. Okay, and the answer, we're getting a whole lot of them, it is common stock. So the answer is common stock. Now the next several questions are related. So it's like a problem, a data set that has a lot of questions about a stock split. So we have this stock split. A corporation had 30,000 shares of $1 par value common stock issued and outstanding. On July 25th, the corporation declared a 2-for-1 stock split. So the first question is, what's the total par value of the common stock before the stock split? So total par value of the common stock before the stock split. So if you're online or in class here, type the number for the total par value. Okay, the par value is, the total par value is indeed 30,000 that we see rolling through the window. It's the 30,000 shares times the $1 a share. So par value, 30,000 shares times $1 a share gives us total par value of 30,000. And we're going to continue with that same set of facts. I think I have about 5 questions about this stock split. So it kind of illustrates what goes on with a stock split. Okay, next question is question 19. How many shares are outstanding after the stock split? So before the stock split, we had 30,000 shares. How many shares are outstanding after the stock split? When we have a stock split, it's a 2-for-1 stock split. What that means is that every shareholder, instead of 1 share of stock, will now own 2 shares of stock. So the answer in this case is going to be 60,000. So it's 30,000 shares times 2 shares each. So a reverse stock split would be saying instead of 1 share, you have half a share. So a 2-for-1 stock split means simply that we're dividing that stock in half, and you now have 2 shares for instead of 1 share for every share you had. So there will be 60,000 shares outstanding now. The next question is related again. So the next question says, okay, so what's the par value per share after the stock split? So the par value per share after the stock split. It's going to be 50 cents. So I saw a lot of 50 cents going by in the window. That's great. And basically, you take the $1 before stock split of $1 divided by 2, because now we have 2 shares sharing that same par value. So it's 50 cents par value per share after the split. So the split, we issue twice as many shares, so now they're each par value is half of what it was before the split. So question 21 now. Same set of facts, one more question on this. And that question is, what's the total par value of the common stock after the stock split? When you have a stock split, it does not change total par value at all. It simply makes each par value for each share half as much as it was before. We have twice as many shares. So the total par value of the common stock after the stock split is going to continue to be 30,000. Now it's 50 cents a share times the 60,000 shares to give us that same total par value of 30,000. Okay, and then let's see, question 22. Okay, so same set of facts. We continue with it. So what happens to total stockholders' equity after the stock split? So everything in stockholders' equity, retained earnings, common stock, everything, what's the total effect after the stock split? So what we see here for this one is it doesn't change. A stock split doesn't change the overall scheme of things. So it does not change. Okay, now if you're in class with me right now, Haley's pushing out a question to you, not related to anything else. It's just asking for 1 or 2 words. So it's not a question related to class per se. So if you're online, don't worry, you're not missing anything. So if you can answer that. With what's due this week, Saturday, April 19th, again, we have the attendance quiz, which focuses largely on these questions we did today. And we have the Chapter 10 homework. Again, Chapter 10 homework is coming from what we did Thursday last week and from the video quizzes. And then Sunday, April 20th, video quiz 23.